What happens when the majority of people can't afford to retire? We're about to find out. A retirement crisis is looming dead ahead. Find out why, as well as what steps you can take to increase your odds of securing a comfortable retirement. Welcome to Wealthion. I'm Adam Taggart, founder of Wealthion, here with a short explainer video providing a reality check on the brewing retirement crisis in America. The situation really is a lot worse than most people realize. This topic is particularly relevant to most of you watching this video, as I recently surveyed the Wealthion audience and nearly a full half of you replied that, quote, being able to retire comfortably is your primary wealth building goal right now. So let's dive right into it. And I'll be blunt, when it comes to retirement savings, we're in trouble. Every generational cohort is behind where it should be. The stats I'm about to share are for America, which admittedly doesn't have as much state-funded support for retirees as some other countries, especially those in Europe. But even despite that, like the US, nearly every other country is seeing a similar decline in retirement readiness. Simply put, we're not saving enough to retire. We're putting too little money away. And the retirement game has changed. Rock bottom interest rates have made it impossible to live off of a fixed income generated by conservative investments, as past generations did. Rising inflation is now eroding the purchasing power of our savings as well as our Social Security checks. And thanks to the benefits of modern medicine, we're living longer. And that means more retirement years that need to be funded. So we need more retirement savings than ever, but based on current statistics, we're failing badly at socking away enough money to come anywhere close to meeting our needs. Let's start by taking a look at the youngest cohort of workers, Gen Z. This article appeared on MarketWatch today, ringing the alarm that, quote, Gen Z is wildly unrealistic about how much money stocks, crypto, and other investments will give them for retirement. Based on his research, the author, Mark Hulbert, calls them, quote, essentially clueless on how to build up wealth over their lifetimes. Citing a recent survey conducted by Magnify Money, in which 27% of Gen Zers share their goal of retiring by age 50, Hulbert then conducts a highly generous calculation of how much they can realistically expect to amass by that age. Now, folks, I'm going to walk through a little math here, but don't worry. It's pretty simple, and it'll be over quick. Hulbert assumes that the average Gen Zer earns the average salary each year, with salary raises matching the national average, that they start with a 401k of $26,000, that's the current average for Gen Z, that they contribute 15% of their salary to that 401k each year, again, that's the current worker average, with a 3% employer match on top of that, and that they invest 100% of their retirement savings in the stock market, on which they receive a reliable 6% annualized return above the inflation rate. Now, with these rosy assumptions, our Gen Zer will end up with only about $600,000 25 years from now. Assuming a yearly 4% withdrawal rate, that leaves just $24,000 a year to live on. And recall, we're talking about 25 years into the future. The purchasing power of that $24,000 will be worth much, much less than it is today. And sadly, Hulbert says that even this meager $24,000 per year is magical thinking. As many of the recent experts on this program have predicted, Hulbert warns that markets are so overvalued today that almost no matter which valuation indicator you choose, markets are likely to deliver negative inflation-adjusted returns for the next decade. As this table shows, the average of the various indicators he looks at is negative 5.4% annually for the next 10 years. If the return is only 0% for that period, our Gen Zer's $24,000 annual retirement payout drops to only $11,000. And of course, if the return is actually negative, that payout number only drops further. So, Gen Z is behind the curve in terms of retirement savings. But those kids have time on their side. Who knows? Maybe they'll smell the coffee in a few years and really start ramping up their savings efforts. In my opinion, we need to be ringing a much louder warning bell for the older generations who are closer to retirement age, as they have much less time to add to their savings and they are woefully underfunded at present. The table here is of data straight from the Federal Reserve, showing the mean or average level of retirement savings by age cohort. I want you to note two things. First, every single age cohort is not saving enough. The totals here are not sufficient to provide sustainable, forget comfortable, annual payouts over decades of retirement. Second, these numbers represent the average retirement savings by these age groups, meaning they are skewed higher by the millionaires in the sample. When we look at the median retirement figures, the picture becomes a lot more dire. Remember that the median value is the midpoint, where 50% of the respondents in this sample fall above this number and 50% fall below. So, reading this, 50% of households in the 65 to 74 age cohort have less than $165,000 in retirement savings. That is nowhere near enough to fund 20 more years of living. These folks just can't afford to stop working unless they get substantial support from elsewhere, which the vast majority are not going to get. When it comes to retirement preparedness for America as a whole, they say there are three legs to the stool. The first leg is personal savings. The second is entitlement programs like Social Security and Medicare. And the third leg is pensions. Okay, so we've just seen how Americans are getting a failing grade when it comes to personal savings for retirement. How are we doing on the other two legs of the stool? Not well. Funding for our entitlement programs for seniors is in dire straits. The nonprofit watchdog truthinaccounting.org calculates that Social Security is underfunded by $41.2 trillion. Even current projections from the U.S. government itself calculate that Social Security will be unable to pay scheduled benefits in full and on time starting just in 2034. Truth in Accounting estimates that Medicare is underfunded by an even larger amount, $55.1 trillion. Without major reforms, it's difficult to see how eventual cuts in health benefits to seniors can be avoided. That's stool leg number 2. And then leg number 3 looks just as bad. Our pension system is a ticking time bomb. Too little money paid in, too much money being paid out, and poor management of the capital inside of the funds themselves. If you really want to hear the gory details, watch the interview I recorded with pension fund whistleblower Ted Seidel. I'll put up a link to it here. He's the top expert on the subject, and he predicts a number of public pensions are going to start failing during the next big market correction. But the punchline's this. Analysis conducted by the Pew Charitable Trusts calculates that in total, public pensions are underfunded to the tune of $1 trillion, and that's a big improvement over past years due to the amazing performance of the stock market in response to all the recent monetary and fiscal stimulus. But as Ted Seidel worries, how much bigger will this gap grow when the markets fall instead of rise? So, our national retirement system, Stool, looks awfully shaky. But believe it or not, its prospects are even worse than what we've discussed so far. Why? Well, for starters, inflation. Inflation is the enemy of retirees. It eats away at the purchasing power of their finite savings. And the higher inflation rages, the less your savings, your Social Security check, and your pension, if you're one of the minority fortunate enough to have one, will buy. Next, most of the experts we've had on this channel recently predict a substantial market correction within the next 6 to 18 months. Remember how underfunded personal retirement plans and public pensions are right now? Well, what if they got cut in half? That's pretty horrific to contemplate, but that's exactly what venerated investors just like Jeremy Grantham predict is likely to happen. And if such a correction were to happen, a recession would likely ensue. Though we don't need a market correction for a recession to arrive. Economic growth was sluggish before the pandemic and all its stimulus arrived, and it's now slowing again, managing only 2% in Q3 of this year. During recessions, workers lose their jobs and layoffs as companies cut budgets or go bankrupt. Without income, laid-off workers can't save, which pushes back retirement prospects. But all right, enough of the gloom. How can you increase your own personal odds of being able to retire and retire comfortably? Well, we've got several recommendations. First, develop a plan. As they say, To fail to plan is to plan to fail. Yet of US adults, nearly 1 in 5 men and 1 in 3 women do not have a plan for retirement. And of those who do, the majority do not have it written down. So do the math. Determine how much money you calculate you'll need to retire with the lifestyle you want. Then crunch the numbers based upon your expected earnings over the rest of your career. Is your goal realistic? If not, adjust it. And once you have a realistic target, build a savings program to hit that goal. As always, Wealthion highly recommends you enlist the support and expertise of a professional financial advisor in this exercise. Their experienced counsel is worth its weight in gold here. Second, save more and invest more. Build those important financial muscles. Find ways to reduce your household's cost footprint so that you can direct more of your income towards your money goals. And track your progress, ideally using a spreadsheet or popular software like Quicken or Mint. There are a bunch of good ones out there these days. The more you do this, your focus will inspire creative thinking on new ways to improve your momentum. As they say in business operations, if it doesn't get measured, it doesn't get moved. Third, create new streams of income and funnel that income into savings. If you didn't see my video last week on the topic, here's a link to it. And you should definitely get the accompanying free primer explaining the most common ways to create additional inflation-adjusting income streams, which you can access that for free right now at wealthion.com/income. Fourth, take advantage of market opportunities that arise along the way. There will be moments where high-quality assets go on sale. For example, a great company can stumble, dropping its share price and giving you the opportunity to buy value on the cheap. Or maybe we have Jeremy Grantham's 50% correction, and suddenly you can buy today's companies for half the price. You want to position yourself to be able to take advantage of such serendipity when it arises, and also to not be among the crowd that gets pummeled on the other side of the trade. This is a big reason why keeping some dry powder on hand has merit. Cash reserves are an easy way to do that. And to defend your portfolio from a substantial market downturn, Wealthion's got a free guide explaining the most common hedging practices to consider. You can get that for free at wealthion.com/hedge. Fifth, teach your children what you are practicing here, because they won't learn it at school. I should probably do a video dedicated to this topic, as it's so important. In fact, let me know in the comments section below if you'd like me to. But suffice it to say, our education system fails completely at teaching our kids financial literacy, which is crazy because that's the whole premise of school, to prepare us to succeed in life. The miracle of compounding bestows tremendous advantage to those who adopt prudent financial behaviors early in life. This simple chart here assumes a 7% real average annual market return. It shows that the early investor enjoys returns over time that are more than double someone who starts just 10 years later. Give your kids that gift of starting early. And last, as you work your plan, constantly iterate and improve it. You'll think of new ways to accelerate your savings rate. You'll have setbacks that'll need to be addressed. The macro environment will change, and you'll need to adapt with it. This is a living, continuous process, just like maintaining a healthy body. It deserves your regular attention. Which is why I'll make the case one last time to work in partnership with a professional financial advisor on this journey. They'll help you keep focused, and their expertise, if they're any good, should help you hit your goals a lot faster than doing it all on your own. If you've got a good one, great. Send them this video and ask them to sit down with you to map out your plan from here. And if you don't have a good one, then consider reaching out to the financial advisors that Wealthion endorses, the same ones who you see appear with me on this channel every week. You can have an initial consultation with them for free with absolutely no commitments. If that sounds of interest to you, just fill out the short form at wealthion.com and we'll connect you with them. All right, as we wrap up here, don't forget to get the free reports I mentioned. There's the report on developing inflation-adjusting income streams, which you can get at wealthion.com/income, as well as the free primer on how to hedge your portfolio against a market correction at wealthion.com/hedge. I think you'll find these resources quite helpful. If you have other topics that you'd like to see me cover in a future explainer video on this channel, like raising financially savvy kids, which I mentioned a few minutes ago, let me know what they are in the comments section below. And don't forget to help this channel reach more viewers just like you by first hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it if you haven't already. Thanks so much for doing that, and thanks for watching.